Okay, so whatever it is, that's site preparation cost. What again? Wages of personnel, wages of personnel involved in the construction wages of personnel involved in the construction of the assets. It can also come in as a directly attributable cost. Okay. Another one is testing costs. Testing costs less sales proceeds. Sales proceeds from sales of samples. Okay, I think this is okay. Why not? That can also be there. Okay, so I kind of asked this severally for 4 marks, that you should list directly attributable costs. So it's a potential exam question that you really need to know. So in any order, you can arrange it. So which one is not clear here? Initial delivery, as in fact, you can separate these two. Initial delivery, assembly, you can separate it. Installation, to install, right? Probably you need to, let's say is a fitting that you need to install it somewhere. Whatever thing you are installing, depends. Installation can vary depending on the item. Okay, if you have to pay somebody for that, installation costs. Handling, just your safe handling it. Probably maybe you need to pay insurance, for example, now on that item from the point of carrying it to the safe delivery. That insurance within that period, okay, can be handling. Probably you need to incur some cost of packaging to ensure that it doesn't break. Is handling and all of that. Site preparation cost. This one also depends on the assets. Okay, it could be maybe you want to do a pavement for the asset, you want to clear the land, whatever, depending on the asset. Wages of personnel that are involved in constructing the asset. This is only relevant if you have constructed the asset yourself. Okay, that is where this one is relevant. So the wages of staffs or laborers that are involved in that construction, you capitalize it. Testing costs less sales proceeds from sales of samples. So this means that if you have to test the asset, whether it's operating properly, okay, that cost of testing will capitalize it. And that cost of testing is probably maybe you need to buy some materials just to see whether the asset is working properly. Any costs that you incur in that process, yes, is a testing cost just to see whether it's working properly. So let's now assume that you now tested, it's working properly. You were now able to come out with a product from that testing process. You now sold it and make money from that. So the standard is saying don't recognize that as income. Don't recognize it as what? Income, because at this level, the asset is not ready for use. Okay? At this level, in order to match that income with the costs, just come and remove the proceeds, the money you got from selling that samples. Come and remove it from the cost of the asset. Remove it from the testing cost. Okay? That's the idea. So you need to be very careful of this one. Yeah, you need to be very careful, but I've never seen I can ask it before. I don't know why. But we always emphasize it every diet, that testing costs, whatever money you now paid or made from selling those samples that you got from those testing processes, we say that you remove it from the testing cost. That is particularly important for you. Then, professional fee, depending on the type of asset. There are some assets that will require that a lawyer signs a contract, or probably you want to build a structure, you need to get an architect, you need to get an engineer and all of that. Those has to be capitalized. Okay? So these are directly attributable costs. You need to know, I mean, based on how your exam is asked, you need to know all of this. But beyond cramming this, what is more important is the fact that you need to understand that these costs are the costs you incur between when you bought the assets and when you start using it. Between when you bought the assets and when you start what? Using it. Okay, so whatever cost you incur to get the asset to its location and condition. Okay, so when you start using it is even relative. If it's not a cost that will get it to to the condition, if it's already in that condition, if you now start incurring some funny costs, you're on your own, it will not be capitalized. Okay, good question. Training employees how to use the asset. Is it a directly attributable cost? No. It's not a directly attributable cost. Training cost does not bring it to its condition. It's already in that condition. It's just that we don't know how to use it. So you expense it. Okay? We don't know how to use it. It doesn't affect the asset. It's higher. It's higher, Abi. It becomes negative for you. I mean, if this one is 50 naira, Abi, and let's say this one is 100 naira, is minus 50, it will reduce your total cost. That's exactly what it is here. Okay? So those are directly attributable costs. Number 3, number 3, initial estimate of dismantling, removal, and restoring the site to its original condition. Initial estimate of dismantling, removal, and restoring the site to its what? Original condition. So this is also added to the cost of the asset. And this is a situation where there is a requirement or an agreement with either the government or the community, or you as an entity, you are committed that at the end of the useful life of these assets, I'm going to remove it from where it is. Okay? If we have that kind of situation, that is where this one is applicable. Initial estimate of dismantling, removal, and restoring the site. So it is not a cost that you are incurring now. It's not a cost you are incurring at initial measurements that we are talking about here. It's a cost that will be incurred in the future. And that is why they call it what? Initial estimate. It's an estimation that you can do. It's a cost, it's a future cost. Okay? It's a future cost. Now, learn one thing now. We don't work with future cost in reporting. When you have a cost you will incur much later in the future, especially after more than 1 year. Let's say you are incurring 50,000. You cannot record 50,000 today because of time value of money. Okay, so whenever we have an estimate of future costs, what you recognize today is the present value of that future cost. What you recognize today is the what? Present value of that future cost. So remember this, because in every other thing we are going to be looking at, whenever I mention future cost, know that it's not that future cost I will recognize today. What I'm recognizing today is the what? The present value. What's the today's value? And in the exam, what the examiner will give you, the examiner will give you the future value. They can give you 50,000. They cannot give you a discount rate of 10%. Or they simply give you the discount factor. And they will, that means, and they will not say anything. That means you need to know that you need to derive the what? Present value. You need to know. And how do you derive the present value? Is future value into a bracket 1 plus r raised to power minus what? N. The future value into a bracket what? 1 plus r raised to power minus what? N. That will give you the present value. So it's like saying 50,000 into a bracket 1.1. Let's say the useful life of this asset is 10 years. So this is minus what? Minus 10. Whatever you get here will represent the initial what? Estimate. Can you punch your calculator and give me a figure? How much? Okay, maybe you don't know how to do it. You will be calculator segbe okay. Okay, 19,277. Okay, that's 1.1 raised to power minus 10. Whatever you get, multiplied by 50,000. 19,277. Abi? 19,277. This is what you are going to recognize as part of the cost of that asset. So that means with this amount, you are going to debit that PPE. Abi? With this amount, you debit the what? You debit the PPE. What do we credit? What do we credit? You know, for this one and these ones, the purchase price and all of that, you debit the PPE, you credit bank, abi? Because most of them you are paying them outrightly. This one, the same thing. Most of them you are paying them or incurring them outrightly. You debit the PPE, you credit what? Bank. But for this one, which is the initial estimate, which is a cost you incur in the future. So you debit PPE, what do you credit? Payables, abi? But what payables exactly? What type of liability? Because it's not like a payables is like you are owing somebody. This one you're not in is a non-current liabilities, but Mr. Ibrahim have taught you IAS 37. Which standard have you done? It's only IAS 10. You credit provisions. Okay, you're not, it's not like you are owing anybody. So you cannot credit payables or other payables. No. This is a provision, and you see him mentioning this under IAS 37. And the IAS 16 says that before you can add this to the cost of these assets, it must meet the criteria under IAS 37, provisions. It's only if you can recognize it under provisions, then you can bring it here. Otherwise, that means you will not recognize it in the books at all. Okay? But for now, it's part of the cost of that asset. Now, there's a lot to this that you're going to learn later. Because whenever we get present value in reporting, it has implications. Because as you move through time, this discounting that you did, because this is discounting, as you move through time, even though this one is historical, it will not change forever. It's there in your PPE. But you see these provisions, you'll be updating it year in, year out. So as you move through time, you need to be unwinding the discount. That discounting you have done, as you move through time, you need to be what? Unwinding it. Every year, you're going to be unwinding the discount in such a way that after 10 years, or at that 10 years, that provision should be 50,000 in your books. It should be 50,000 in your book at the end of every year. Yes. Yes. Oh, okay. 1 plus 10%. So that's like saying 1 plus 0.1, which is 1.1. The discount rates. And they will always give you in the exam. They always give you that 10%. Okay, so let me not go too far, right? I wanted to go into that unwinding of discount, but let me not go there. Let me still keep it simple for you for now. At least learn the basics first. So that's the third one. Are you with me? The final one. Borrowing costs that are attributable to the acquisition and construction of the asset. Borrowing costs that are attributable to the acquisition and construction of the asset. That will also be capitalized. Okay? These are the four that we have. These are the four that we have under initial measurements. Thank you. Okay, so let me explain borrowing costs. Now, this one is just a fast forward knowledge. I'm still going to teach you this as a separate standard. But for now, listen up, okay? When you are constructing an asset and you now borrow money to construct that asset, you pay interest on that borrowings. That interest is borrowing cost. And I was very specific. Those three phrases I made, when you are constructing an asset, you now borrow money. That interest is borrowing cost. So that means this borrowing cost must be such that the money was used to construct an asset. If you are not using it to construct the assets, it will not fly. It's something else entirely. It's normal finance costs. Okay? But the ones that is attributable to a fund that you are using to construct the assets, then that interest, you add it to the cost of the assets. Okay? And I say that is attributable to the acquisition and construction, which means that as soon as the construction is complete, as soon as the construction is what? Complete, and you are still paying interest, that interest will not be added to the cost of the asset anymore. Because it's not attributable to construction anymore. It's attributable to usage or whatever it is then. But the one we are talking about now is the one that's attributable to what? Construction of the asset. I will still teach you this as a separate topic. So I'm not really going to emphasize it when we are solving questions that much. because it's not really on it. But I mean, know that something like that exists that we add to the cost of an asset. So that is it for components of costs.